Welcome to the Real Estate Espresso Podcast, your morning shot at what's new in the world of real estate investing. I'm your host, Victor Menasce. It's no secret that homebuyer activity has shrunk significantly over the past year, but which parts of the market have cooled the most? On today's show, we're taking a look at which segments have cooled the fastest. Is the pullback in starter homes, in luxury homes? Have investors stopped buying? What about families? Investor activity in the for-sale housing market has been closely watched through this roller coaster that we call the pandemic. But like other buyer categories, investors are purchasing fewer homes these days in the wake of changing market conditions and higher interest rates. Seattle-based Redfin found among 40 major U.S. housing markets, investor purchases fell a record 45.8% annually in the fourth quarter of 2022. The biggest declines in investor purchases were primarily in Sunbelt markets that have seen rapid cooldown from the scorching appreciation we experienced in 2022. That includes Las Vegas, a decline of 67% over a year earlier. Phoenix, Arizona, 66.7%. That's down 66.7%. Nassau County, New York, down 63%. Atlanta, down 62.8%. And Charlotte, North Carolina, down 61.9%. And while investors aren't as sensitive to interest rate escalations as other types of buyers, some institutional groups have pivoted to other asset classes after the housing market began to slow down in the middle of 2022. And while investors are buying fewer homes these days, their market share continues to be steady compared with other buyers. Investors bought 17.8% of all homes purchased in metro areas tracked in Q4, and that compares with 17.6% observed in the prior quarter and down from 19.4% in Q4 of 2021. Not a huge shift in the proportion of sales that are going to investors. But even with the cooler rental market, it's unlikely that investors that purchase homes to rent will look to offload properties this year. And that's especially because of continued low inventory. Salma Hepp, the chief economist at CoreLogic, reported that her firm has found institutional investors are pulling back more dramatically than small investors or groups that own 3 to 10 properties. Those investors do remain active in the market, which is interesting. It's also contrary to what's otherwise happening. They also tend to purchase with a higher proportion of cash, and they're not as sensitive to the mortgage rate environment. That suggests some confidence is held by smaller investors that the housing market's going to recover. That confidence remains especially high among groups that rent out their properties instead of flipping them. Cash buyers remain an important component of the housing market. A recent analysis from Atom Data Solutions found that all cash purchases accounted for 36.1% of total home sales in 2022, the highest rate since 2013. Although all cash purchases are found across the buying spectrum, investors are more likely to be cash buyers than owner-occupants. In some Sunbelt cities, where home price appreciation has cooled significantly, but migration remains strong, cash purchases were overwhelmingly the majority of home sales last year. In Augusta, Georgia, for example, 72.1% of home sales were purchased with cash, a 17% increase from 61.6% in 2021, and more than double the 30.2% share in 2020. Dallas-based Invitation Homes, which owns more than 74,000 homes nationally, in an earnings call last week signaled a modest pace of acquisitions is likely for this year, but buying activity will be based on cost of capital as the year progresses. In Q4 of last year, Invitation Homes and its joint ventures sold more homes than it purchased, having bought 166 homes for $64 million, while selling 199 homes for $67 million. In fiscal year 2022, the company and its joint ventures bought 2,502 homes for a total purchase of $1.084 billion, and they sold 726 homes for $269 million. Dallas Tanner, the CEO of Invitation Homes, made reference to constrained housing supply during the analyst call, in addition to angst facing builders in the current environment. Invitation Homes had 2,300 homes in contract with different builders. Despite a cooler housing market, significant amount of buying activity by companies like Invitation Homes in the wake of the global financial crisis in the early 2010s is unlikely to be repeated, as home prices are much higher now and supply is very tight. Distress is also not very widespread in the housing market because most homeowners remain equity rich. Companies like Invitation Homes were able to scale significantly in an environment where they had years of supply on the market at a very attractive price, and the cost of capital was also very attractive. Today's environment, there's less supply and interest rates are high. It's much more difficult for companies to scale in that environment. In the ultra-luxury segment, there seems to be almost no signs of slowdown. In total, there were 44 sales across the United States priced at $50 million or more. That's down from 48 sales in 2021. Still the second highest on record. And it's a significant uptick from the 23 sales in 2019 in that ultra-luxury $50 million plus range. What it really shows is that interest rates don't matter, and it's really recession-resistant. At the very high end of the market, the ultra-luxury segment, it's separated from reality. In the next couple of years, there could be opportunities for mergers and acquisitions for small to medium-sized portfolios because of interest rates, because a lot of these portfolios were financed with bridge debt. I think the small investors that are just starting out need to pay very close attention and mimic what the large institutional players are doing. If the large institutional players are pulling back, well, so too should the small investors, at least for the time being. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.